What's up, and welcome to Crash Course AP Macroeconomics Edition, Video 3. Crowding out. Crowding out is when the government spending might cause unintended effects that weaken the impact of the policy. So, for example, deficit spending will increase aggregate demand, but it will also increase interest rates because we're starting to demand more loanable funds to start funding this excess spending. And as a result, higher interest rates would actually crowd out the economic policy and decrease investment by other consumers. Assets. Assets are any item of economic value that can be converted into cash, something that can be owned. So most people, their measure of wealth is by measuring their assets. Liabilities. Liabilities are the opposite of assets. It is a legal or financial obligation that must be paid back. It's something that's owed, so this could be any type of debt. Liquidity. This is a term that describes the ease in which an asset can be converted into a medium of exchange. So now it's talking about money. Cash and money in checking accounts is very liquid, as you can readily take it out and use it. However, a car or a home is not very liquid because, of course, you have to sell it to get the money to spend. 3 functions of money. Money has 3 functions. They are a medium of exchange, so if you want to go to the store, you can use it to buy something. 2, a unit of account. Money regulates prices, so if milk is like $3 a gallon, that's a unit of account. And 3, a store of value. You can store money and it will have value into the future. So if you put $5 in the bank today, it should have $5 in the bank tomorrow. Types of money. There are different types of money. One type is commodity money. This is money that has other value besides just money itself. So it might be like gold, because gold has other value as a precious metal. Fiat money is really just the paper money that we see every day. Money can be measured in different ways. There's M1. M1 are assets as a medium of exchange. These include currencies, demand deposits, which are deposits you can directly take money out of, traveler's checks, and also checkable deposits that earn interest. N2 are less liquid types of money, and these include savings accounts, money market mutual funds, MMFs, small time deposits less than $100,000, and really just things you can't take out immediately. And credit cards, they don't really fall into any of these because it's kind of like a deferred payment. It's a loan for you to buy something now and you pay back at the end of the month. A mutual fund. This is a fund that pools the savings of many individuals and invests this combined money in a variety of stocks, bonds, and other financial assets. People want to do this because it reduces the risk. If the thing they're investing in goes upside down, then they only lose a little bit of money because the risk is diversified throughout the many people who input their money. Stock index. This is a statistic that tracks how the prices of a specific set of stocks have changed. So in the US, there are many different types. One type is the Dow Jones Industrial, and this measures the average stock of 30 major corporations in the United States. There's also the S&P 500, which is the Standard & Poor 500, and it measures the stock values of 500 corporations. This gives sort of an aggregate average of how a stock or group of stocks are performing in a certain day. The Federal Reserve. So this is the central bank of the United States, and it regulates the commercial banks and adjusts the money policy to adjust interest rates to meet economic goals. The Federal Reserve is in charge strictly of the monetary policy in this country and how it deals with our money supply. So what are some stuff the Fed does? Well, they are in charge of the reserve ratio. They can decrease the reserve ratio to then increase the money supply in the economy. So that's the amount that banks have to hold inside. Usually it's around 10%. They can also adjust the discount rate. This is the rate at which banks can borrow money from each other. And this, if they decrease the discount rate, they can start to increase the money supply. They can also host open market operations. This is when the Fed starts to buy bonds to increase the money supply or sell bonds to decrease it. And the Federal Open Market Committee, the FOMC, is in charge of this type of monetary policy making. And the Federal Reserve also serves as a lender of last resort. If banks cannot start to lend other banks money, they can come in and start to lend money themselves because, they have the big vault of cash. Maturity. Maturity is when a borrower issues a bond that must be paid back by a certain amount of time, and that certain amount of time is the time of maturity. And a bond can be sold early before it matures at an agreed upon price, but most bonds are sold when it matures, and it will usually gain value by then. Junk bonds. So most bonds are good, such as from the US government, but some are bad. And these types of bonds carry a high interest rate. And so you might win or you might lose. And it also carries higher inherent risks. And because you want to have more stable money in a bond, these types of bonds generally aren't good because of the high risk. Fractional reserve banking. This is a measure of banking that most banks today use. It's where banks hold a portion of deposits in reserve, usually like 10% required by the Federal Reserve, and loan the rest of the money out. When they loan the money out, the money multiplier can make this money actually earn more and help them to earn more later. So that's why they practice this type of banking. And excess reserves. This is the amount that banks are legally free to loan out after they have stored away some of their required reserves. So excess reserves and required reserves together, they will make up the total amount of reserves a bank or financial institution has. Demand deposits. These are bank deposits that can be withdrawn at any time. As we talked about before, this is like M1. It's a fairly liquid amount of measure of currency that we can use. Loanable funds market. This is a graph that shows the relationship between interest rate and the quantity of loanable funds. Interest rate is, of course, the rate that is charged for interest, and the quantity of loanable funds is like bank savings, so the amount that banks and other financial institutions can loan out to the economy. It is represented by a supply and demand curve, and so it follows many of the same things as a normal supply-demand curve. Loanable funds demand shift. So the demand can shift for loanable funds for many reasons. One reason is a change in perceived business opportunity. So if you think your business is really going to grow in the future, you might want to invest in it. And if you don't have the money, you'll want to demand more loanable funds to invest in this company. Another reason is changes in government borrowing. And this is with the crowding out we talked about. If the government wants to borrow more money to start to spend more and also cause deficit spending, they might need to start to borrow more money, and this will start to increase the demand as well, driving up the interest rate, which will eventually spur other consumers to try to invest less because of the higher interest rate. The loanable funds can also supply shift, and this can happen for reasons such as a change in private savings behavior or public savings behavior. So if we have very high tax rates or very high interest rates, people might want to start to save more of the money into banks or save the money for later on, and this will increase the supply of loanable funds. There can also be changes in foreign personal investment, so if a rich person wants to invest in a type of currency, that will also change the supply of the loanable funds, and also changes in expected profitability. If people or businesses are earning a lot of money, they might want to save some more. So like Apple itself, it has like $1 trillion in the bank. So then they might want to start to save more money as well for later on to invest later. Exports. Exports are the sale of goods and services created by domestic producers and sold to foreigners. So if you're in the United States, this is stuff the American economy makes and exports to other countries. So one example of an export would be cars, because we make a lot of cars. Imports. These are the purchase of goods and services created by foreigners. So the U.S. has a lot of imports. We import a lot of things from places like China, consumer goods that we use. Net exports. This is exports minus imports. It's the difference between a nation's exports of goods and services and its imports of goods and services. And it is represented by the letter X in GDP. Trade deficit. So this is what happens when we start to export less than what is imported. So the U.S. is currently in a trade deficit. We're exporting things to a lot of countries much less than we're importing stuff from places like China. Trade surplus. This is exporting more than what is imported. So we used to have a trade surplus because America used to have a lot of industry and blue-collar workers who would make stuff and export to other countries, but we've shifted away from that to more service-based industries, so we're not really exporting as much. And balance of payments. This is a summary of all the international transactions within a given year prepared in the domestic country's currency. This really shows the flow of trade between two countries, and it includes things such as the current account and the capital account. The current account measures all the goods and services, really the consumption aspect, while the capital account measures the flow of different types of investments like real estates. Current account. So we talked about this, but it's the measure of international trade in goods and services. It also includes investment incomes and also net transfer payments between different countries. Capital account. This is the other type of measurement in a financial account, and it shows the international trade of financial assets like stocks, bonds, and real estate. Really, any money that is invested to try to grow it or save it for a different type of day is included in this type of account. Net capital flow. This describes the difference between the amount of money coming into a country to buy domestic assets and the amount of money leaving a country to buy foreign assets. So generally, most countries want the amount of money coming into the country to be more, so it can really jumpstart that country's economy. While if your money is leaving to invest in foreign places, that's not good because your money is not being put to work in your domestic country. Foreign exchange market, the Forex. So this is a market in which currencies of different countries are bought and sold. It shows two different things, the exchange rate between two different countries. So in this case, it's the yen and the dollar. And it also has on the x-axis the quantity of dollars traded. This is also following a supply and demand curve. And it really just shows how money will change between different sources as money between different countries are exchanged and bought. There are many common types of currency, so I just listed some here. These are good to know. I'm not sure if they're required for the AP exam, but they're good because these are some of the major types of currency that are commonly traded in the world today. Appreciation. So common currency, it can appreciate in different markets. So an increase in currency in comparison to another country is when money appreciates. You want money to appreciate because then it starts to worth more. Depreciation is the opposite of this. This is when there is a decrease or loss in value of currency. So if you start to have more of a certain currency in the market, that will cause inflation and that will depreciate a type of money. Or if another country's currency starts to be worth more, yours might start to be worth less. Forex shift. So the market for currencies can change in many different ways for different reasons. One reason is a change in taste. So let's say people want to buy French products now, so then they might start to demand more French currency, and that will be good for the franc. And also, a change in relative income could change the amount of currency in a different country. So if a country is starting to earn more, their citizens might have stronger demand for that country's currency to buy more things, and that will help their economy as well. Also, changes in relative price levels. Price levels, if you have too high of a price level for a certain type of currency, that's not good because it causes inflation. So you want sort of lower price levels to keep a currency strong. And also changes in relative interest rate. If a different country has a high interest rate for saving for their types of currencies, people might want to take their current currency in exchange for that foreign type of currency. So when they store that money in the foreign banks, they can earn more interest. That changes things as well. And finally, one thing we'll leave off with is a term that will help you remember monetary policy and the Federal Reserve, so it's bigger bucks. Basically, if you buy bonds, the federal government will start to buy bonds. There are bigger bucks and more money in the economy because they're buying the bonds back and putting more money into the American economy. And selling securities is the opposite of this. Bonds and securities, they're pretty interchangeable terms. If the Federal Reserve starts to sell securities, they're taking money back in to the Federal Reserve, decreasing the amount of money available in the U.S. market, so smaller stacks. So that's just something that's good to remember. So this has been AP Macroeconomics Exam Cram. Thanks so much for watching. Make sure to subscribe if you haven't already. Also like, comment, and share these videos with your friends. You can find the full AP playlist coming up. And thanks so much for watching, and hope to see you in another one.